If you take a look at the breaking news and research section on the terminal, you'll see this implied volatility levels. If you just open up that tab, you will see this chart here just detailing a number of different instruments. And alongside those instruments, you have the assets implied volatility. That's what that IV stands for. Now, in case you don't know how to use this, implied volatility is a really crucial idea with options trading. And basically, what implied volatility does is it measures the market's expectation for the future volatility of a asset. And it's worked out by the prices of options on that asset. And the way you essentially use it is when the implied volatility is high, that means that option premiums are tending to be more expensive, reflecting greater uncertainty about the price swings in the asset. But when the implied volatility is low, traders are anticipating less volatility, so option premiums are cheaper. So the way that we can use the implied volatility is when you see an implied volatility that's very high, WTI at the moment, that's a good flag, isn't it, to us that oil traders are expecting a high degree of volatility in oil markets. So the implied volatility level is very high. So how might you use that? Well, you might use it, say, for instance, that tells us that expectations are for wildly volatile prices, obviously due in this case to the Israel Palestine invasion, but that's planned by Israel. It's postponed for now, but still planned. And the wider risks to conflict in the area, etc., etc. I'm not going to go into the details of that now, but the point I want to make is that the implied volatility is high. So you could use this if all of a sudden geopolitical risk fades. There's a ceasefire, there's the end of hostilities, and not that it's going to be very possible, but life goes back to sort of normal in inverted commas. Then you would expect the volatility to drop, and those recent elevated prices we've seen in WTI, you'd expect to quickly unwind. You can use it in a whole different range of ways. You can also, it's used for earnings seasons, particularly if you're looking at a stock, for instance. Applied volatility tends to rise before an earnings announcement. And you can also use it just to identify if there's a potential trading opportunity. Look, if you're just looking for instruments that have a high implied volatility, that could potentially provide an opportunity where you're expecting some underlying price movement, which can be good for sort of breakout trading. So just to be aware what that implied volatility is, how you can use it. And you can see next to the instrument, you have, the low that's expected, the high for the standard deviation, 1, 2, 3 levels there, just showing you what the kind of expectations there are potentially for the price, as well as the expected daily move in this column here. So it's a very useful document that Arno's put together for us, and really useful just to have a little look and to see what the implied volatility is for the day, and can help us and inform us with our trading decisions. So it's worth checking out.